Welcome to Politically Basic. I'm your host, Kyle Campbell. On the show today, one of the smartest people I know, Justin Danhof. He's the executive vice president and head of corporate governance for Strive, an asset management firm started by none other than one Vivek Ramaswamy. Prior to joining Strive, Justin held numerous positions at the National Center for Public Policy Research, most recently as the executive vice president there. He's one of our nation's leading corporate activists with vast experience in shareholder engagement and proxy voting. Justin's work has been widely published and quoted in major newspapers, and he's also appeared on the Fox News Channel, One America News Network, and Fox Business Channel, among others. Justin, thank you so much for joining me today on Politically Basic.
It's my absolute pleasure, Kyle.
Well, it's great to see you and have you on the program. You have had quite a journey to arrive where you are now, working at Strive. Can you share a little bit about your history, your experience, and the path that has led you where you are today?
Sure. So after graduating law school, I joined a think tank on Capitol Hill called the National Center for Public Policy Research. It was founded by the late, great Amy Moritz Ridenour, and she really had a unique vision. A lot of people think and hear the word think tank, and they, instantly go to long white papers that are dry and boring in policy, and nobody's going to read them. And are they really influential? Amy wanted a different vision. She wanted us to be more of a do tank. And so she wanted us to be a conservative voice wherever she thought conservatives were the quietest. And she wanted us to be quick and nimble. And so we were structured a lot differently. And what we did was we took a look at the landscape of corporate America. And again, this is about 15 years ago now. And we were just sort of scratching our heads wondering why on policy issue after policy issue, large corporations were teaming up with the policy left. This was a little confusing to us, and so we decided to peel back a few layers of the onion. And we realized that affinity groups from, the Greenpeace and PETAs of the world to the SEIU, AFL-CIO union activists of the world to large state pensions in blue states like California and New York, they were filing shareholder proposals. And they were filing them at large, influential, publicly traded companies all across industry. And they were pushing their pet projects onto the ballot. And again, Amy was always an innovator. So we launched what was called the Free Enterprise Project. And we started filing an evergreen amount of shareholder proposals from a right of center perspective, what eventually the media would come to label as anti-ESG. So for more than a decade at the National Center, I spent my entire spring flying around the country, going from shareholder meeting to shareholder meeting, pushing back at corporate America's march to the left. And so a few years ago, I met up with, as you mentioned, Vivek Ramaswamy, and he had a brilliant idea to start an asset management firm to push back on steroids to, again, corporate America's march to the policy left on so many issues. And so Strive was born. Vivek stepped down to run for president, as I'm sure most of your audience knows. But the mission carries on, that we are here engaging with businesses, voting our proxy ballots 100% in the interest of shareholders. Shareholder primacy is the system of capitalism in the United States that has brought more people out of poverty than any system man has ever created. And that's the system that we need to get back to, and away from ESG, stakeholder theory, and all of the other banners that are moving corporate America away from its true north.
Justin, you're too smart, so bear with me. You said a lot of things that I want us to kind of break down right now. So that was a beautiful, very well said explanation. And I just want to touch on a couple things and have you explain them. I know this is going to be hard, but we're going to do it together. Okay. You're the best. Walk me through the process of how one becomes a shareholder, what that means to a company, what it means to the individual who's investing with that company, and then what rights it gives that person as a shareholder to have any kind of influence in that company. Can you kind of walk us from start to finish through that process?
Yeah, sure. So any individual in your brokerage account, you can buy a share of Apple. You can buy a share of Target or Coca-Cola. And with that comes property rights. And so what you get is the right to vote once a year. And these votes are tremendously important. So every publicly traded company has an annual shareholder meeting where there's three different ballot items that are put up for a vote. First is the election of the directors. Second are proposals that the management team at that company puts forward. And the third are shareholder proposals. And so again, if you own a share in a publicly traded company, you have the right to approve of the board, approve of what the direction management wants to take with their resolutions, and what other shareholders have put on the ballot. And so the problem is, Kyle, when it comes to retail investors, that is individuals investing with their own money, they vote at a rate that is close to a city council vote as opposed to a presidential election. So a lot of individuals are not availing themselves of their own property rights. Think about that, right? This is like living in 1/10 of your home and letting someone else squat in the other 9/10. It just doesn't make any logical sense. In any other arena, we use our property rights and we defend them, right? We have a second amendment to defend our property rights. Yet in so many instances, when it comes to our shareholder rights, we're not availing ourselves of those rights. And the interesting thing that I think a lot of folks wouldn't recognize or realize is that um, when you own even a single share of, as I mentioned, Apple or Amazon, or pick a company that you're interested in, you have the right to attend that shareholder meeting. You don't have to have Warren Buffett type wealth to go to a shareholder meeting. One share inures in you the right to attend that meeting and make your voice heard. And so this is what, again, the activists that file resolutions that work at, AFL-CIO, PETA, Greenpeace, groups called As You Sow and Ceres. These are umbrella organizations. They've known this for decades, and they have availed themselves of their rights. So most shareholders need to get engaged in this game if we're going to be effective.
I'm really glad that you're explaining it this way because I don't think most people understand the power that they hold being shareholders and how to wield that power. So let me use an example here to ask my next question. So let's say I am a retail investor and I have one share of a number of different companies. I've got Google, I've got Apple, I've got Amazon, I've got Berkshire, I've got Pepsi, let's say. What happens when each of these companies, let's say I've got 20 different companies I hold a share of, and I want to participate in that process and have my voice heard as a shareholder, but I cannot get myself to 20 different shareholder meetings. You mentioned proxy voting. What are my options then?
Yeah, sure. So first of all, you've got time, right? What happens is about 6 weeks before an annual meeting, you'll get your ballot, right?
Okay,
And so
Justin, is that teeny tiny thing that they find the world's smallest font type, and you literally would have to put it under like the microscope that's over at the the Griffith Observatory to be able to read? I mean, I don't understand it. It's so tiny. I don't get it. Is that it? Is that my
well,
ballot?
most people get their ballots via email these
Okay,
days.
good.
Although, it's a little, depending on your monitor, it's a little more legible.
Okay, good. I'm glad.
You could have vote. And so, that again, you have 6 weeks to make your vote. And so I know everyone's busy. I know everyone's jam-packed. But again, this is your property right. Don't just ignore your property right, because then what happens is we're talking about retail investors, right? If the retail investors don't vote, they give an extra outsized power to institutional investors. Now, who is this? This is BlackRock. This is State Street. This is Vanguard, right? They have passive funds where folks that invest in things like ETFs, they give away their right to vote to that fund manager.
What's an ETF, Justin?
It's an exchange traded fund. And so when you invest in an ETF, you get access to broader markets or subsets of the market. So, for example, a lot of funds track, the Russell 3000 or the S&P 500. And so you can own a whole swath of companies by just buying an ETF, but you lose that right and you give it to the fund manager.
Which is why they're called passive, right?
Exactly.
Okay.
And so at Strive, I do with a team, a brilliant team, by the way, of experts. I lead all of our proxy voting efforts. And again, at Strive, our proxy voting is 100% pro fiduciary. It is, does this vote drive shareholder value or not? Now, that sounds simple, but it's not quite as simple as I'm making it sound. There's a lot of research that goes into every director, every management proposal, and every shareholder proposal. And why did we decide that corporate governance was going to be the differentiator at Strive? Why did we decide that this was so important? Well, it's because the other large asset managers in this space, BlackRock, State Street, and Vanguard, which, by the way, have the combined wealth that's greater than the GDP of the United States of America.
Which is what? How many trillions?
It's over 20 trillion.
Okay. That's a lot of financial firepower. And when you say sounds simple, I mean, to someone who, this is not my world. I've spent a lot of time trying to understand it. And you have been a big part of that in educating me across the years on how this all goes. But as an investor who does not live and work in this world, it seems simple because to me, I would think, okay, I'm investing in shares in this company with the assumption that this company is going to grow and do well and make choices based on what's best for me as an investor and a shareholder. But that's not exactly always what's happening, right?
No, not at all. So again, why we decided to enter this space is because the big three, BlackRock, State Street, and Vanguard, for so long have used other people's money. Again, it's passive, to push things that fall under the banner these days of ESG and DEI, right? So that's environment, social, and corporate governance, and that's diversity, equity, and inclusion. And so a lot of folks, what I call them is headline readers. They'll see something like, Disney and Governor DeSantis are in a major battle in the state of Florida. Citi and Bank of America are debanking their gun clients. We've got Nike pulling the Betsy Ross tribute shoe at the behest of Colin Kaepernick. And they get very angry at those companies in the moment. What they don't realize is, in many instances, their first, second, and third largest investor are BlackRock, State Street, and Vanguard that have for years been using their voting rights, using their property rights to push companies in the direction of ESG and DEI, which, by the way, just fly under the larger banner of stakeholder theory, right? And so that's why we entered the space that's money that's upstream of these decision makers. And so that's why we started Strive, because we think that this is a fiduciary breach. Okay. When you take possession of someone else's capital, you have duties of loyalty, duties of care. Another term for corporate governance, Kyle, is investment stewardship. And so I think of that in the biblical sense of, I am a shepherd watching over this flock of capital. And it's my job to do what's best for it. Not my personal politics, not my personal preferences, but I have to steward that capital using the voting power that has been bestowed upon me and my team for the best interests of those individuals. And for so long, the big three breached that fiduciary duty in Strive's opinion by taking other people's money and pushing politicized preferences that Larry Fink, the CEO of BlackRock, and the Davos crowd want to see companies do.
Right.
And
And
so,
a lot of this was happening unbeknownst to people who were investing with them. Now, you mentioned companies like Disney who are making financially related or financially driven decisions that the consumer doesn't like. And if you're invested with Disney, it's easy to make that connection of, okay, I don't like what Disney's doing. I'm not going to support them in the sense of I'm not going to watch their content. I'm not going to spend money, in their retail stores or at their parks. It's easy to make that connection there. I think what's a harder leap is to make the connection of, oh, wait, I own Disney shares. I can show up and I can do something about this and speak up. There's this other avenue of being proactive and kind of forcing change on them. And you did this, Justin. Can you share about your experience in speaking up in this way?
yeah, sure. So, I've attended well over 250 shareholder meetings over the years. And really, it was a very interesting experience because I can give you one main example. Years ago, I went to the Apple shareholder meeting. They used to hold it on their campus. It was a hot ticket, right? Because everybody wants to see, the Cupertino campus and all the fancy devices and the cool looking Steve Jobs Theater. And there was a really interesting exchange. Apple under Tim Cook had started a lot of green initiatives, right? And so I simply asked Mr. Cook, I said, look, can you just tell us shareholders that you've got our back in the sense that you're seeking the same types of return on investment in these green programs as you are in, say, the next generation iPhone? And he completely lost it on me. Told me that people that thought like me shouldn't even be in Apple stock, that I should sell and get out, that people with my worldview weren't welcome at Apple. And I found that to be wild. But the very next year, I can say this because he's gone now, the general counsel invited me to Apple's shareholder meeting. And why did he do that? He said, look, Mr. Cook doesn't really hear from folks with your worldview very often at all. And we think as a company, it's probably good that he does. And so I had lots of interesting exchanges like that over the years. And I also filed a lot of shareholder resolutions, which gave me the opportunity to speak at a lot of these shareholder meetings as well. And so, there's different thresholds for being able to file resolutions. And again, the National Center led the way on this, but there's lots of other organizations, and allies that are fighting this fight as well these days. And so, again, we took every advantage we could of our property rights. And I just encourage others, especially in the retail space, to do the same.
Yeah, absolutely. I have another question for you about just logistics having to do with taking advantage of this opportunity to just use your shareholder position to the fullest. Now, obviously, there at Strive, you guys are doing a ton of research on these investment opportunities. So if somebody works with you and invests with you, you're going to give them excellent, well-researched advice and guidance there. But how else, other than hearing about something that sort of explodes in the news, what would you say is the best way for someone to understand what initiatives these companies are taking on?
Yeah, well, do come to strive.com because one thing we've done a lot of, Kyle, is thought leadership in the space, right? So we have example after example of white papers on our website that really go into deep detail on what's happening under the E vertical, the S vertical, and the G vertical, right? I highly recommend that. I highly recommend a book called The Dictatorship of Woke Capital by Steve Suko. This gives you chapter and verse how we got to where we are in the capital markets and how we can get back to where we need to be. That's another great resource. Ballotpedia is another resource that has a lot of information on ESG. Oh, and I forgot to mention at Strive, we have a weekly newsletter called the Fiduciary Focus that really does a deep dive into a lot of these issues. I would also commend speeches given by Commissioner Hester Peirce at the Securities and Exchange Commission, and then look to the state AGs. A lot of state attorney generals are doing tremendous yeoman's work in this space. So there's more resources than have ever been available, frankly, on this topic. So folks that want to get steeped, those are some recommendations that I would make.
Thank you. Okay, Justin, I want to ask you about boycotts. You told me a while ago that you don't think boycotts work or are effective. We've seen some as of late that seem to have kind of moved the needle with some of these larger brands and companies. What's your take today on boycotting? If the public doesn't like something that a company's doing or representing or investing in, is simply just not participating in or supporting them or buying their product an effective way to push back?
Yeah, so Bud Light may have proved me wrong, but kind of a one-off. So, like, here's how I think about boycotting. Right, is you take your voice out of the room, and so BlackRock, State Street, and Vanguard, they don't boycott things like big oil, even though they've got problems with big oil. So they invest in Exxon, they invest in Chevron, but then they try and change their behavior. They try and tell them to lock up oil and gas, right? And so, in my view, a boycott is the same thing as a divestment. And so, when you divest from a company, well, you've given up your rights. You no longer can engage with them. You no longer have your voting rights. And so, if you give up your rights, what gets amplified? The voices that are left in the room. And the voices that are left in the room are BlackRock, State Street, and Vanguard. So, again, divestment and boycott, they're the same in my eyes. And yeah, if you don't want to personally spend your money with a company because they offend your values, I have no problem with that. I'm not telling people that they individually shouldn't go out and spend money at companies that reflect their values. You should. That's great. I just don't think collectively it's going to work as an overall tactic to change corporate behavior. Because again, BlackRock, State Street, and Vanguard have already proven how to change corporate behavior. And it's by investing in companies and engaging with them and exercising your rights. And, think about it from a practical standpoint, too. Every major airline carrier in the United States has, in one way or another, adopted ESG and DEI. And frankly, in an egregious fashion. Like, our proxy votes are all on our website. You can go see what we do at American Airlines, United, Boeing, Southwest. We vote against lots of their directors because they're making lots of terrible decisions under the banners of ESG and DEI. So you couldn't fly anywhere in America if you were trying to boycott unless you are wealthy enough to fly private, right? Like, so that's not very practical. And then once you don't fly to a place, you couldn't rent a car or get in an Uber or Lyft because they've all adopted stakeholder capitalism, stakeholder theory in one way or another. So, like, you're going to have a real tough time engaging in commerce. Like, who are you going to bank with, right? Is it Citi or JP Morgan or Goldman or Bank of America? They're all equally terrible on ESG and DEI issues, right? Well, there's some variance in there, but they're all variants of terrible. So, like, you're not going to engage in much commerce. You're going to probably become some weird hunter-gatherer that lives or you're going to join St. Simeon sitting up on his pole, but he didn't like company, so he's not going to really enjoy welcome you into the neighborhood. So if you want to live in society, you have to engage with it.
I guess so. Sometimes we don't feel like it, but at the end of the day, it's still better to try to make a go of it. A lot of institutions and organizations, we've seen this happening with educational institutions, some companies are starting to back away from DEI. Are you seeing that happen with the ESG initiatives and focus within the investment realm?
Yeah, there is definitely outflows from ESG products, that's for sure. But I would caution those who have been working to expose the ESG movement, shine light on it, and change trajectory. I see a lot of folks spiking the football on what I'd call like the 2-yard line, right? There's been some incremental progress, but not that much. And I can give one strong data point as to why. Last year was supposedly the year of ESG retreat. Okay. Well, last year, more companies in the S&P 500 than ever before tied a portion of their executive compensation to ESG and DEI. It was 75.8%. That's the high watermark. So that's a pretty interesting retreat of ESG when more companies are using it to pay their executives than ever before. So there has been, some incremental outflows of ESG funds, for example. There's obviously what's known as anti-ESG legislation in lots of state houses. There's more sunlight on the topic than ever before. But just because language might change, we really need to see behavioral change. And again, if you want to know why so many companies are making decisions that just seem backwards, that's because everybody is a fiduciary to themselves. So if you pay an executive to hit a diversity hiring target rather than for hiring the best people, well, he's probably going to hire the diverse slate because he wants to get his bonus, right? And so you're not always getting the meritocratic hiring because you're hiring and incentivizing hiring based on race, which, by the way, we can get into this, but that's actually illegal.
Mm-hmm.
Under Title VII of the 1964 Civil Rights Act, there's no such thing as reverse discrimination. There's only discrimination, right? And so one concrete example is just like almost comical, but you have to look at it. So last year, Southwest Airlines gave their CEO his biggest bonus ever. And right in their proxy statement, they say that there's 3 critical components. It's system improvements, response recovery, and then ESG, which they self-describe as DEI and sustainability. Well, they're getting paid on the year where they had flights grounded for 10 days during the Christmas season. Over 16,000 flights were grounded, canceled. People stuck in terminals all across the country during the Christmas season. So how did they do on response recovery? Well, they admitted not very good. How did they do on system improvements? They admitted not very good. But they said they outperformed on ESG. And if you do the math, they outperformed by over 200%. So those of you who got your flights canceled by Southwest, next time you go to fly, feel better about it because they made a lot of diversity hires and they lowered their carbon footprint. By the way, what a better way for a commercial airliner to lower their carbon footprint than to ground your planes for 10 days. Think about that. But this is happening after company after company after company. Go to Disney.
Mm-hmm.
They compensate their executive officers as much for DEI as they do creativity. This is Disney. Like, this is happening everywhere in America.
But Justin, do they care? I mean, I'm talking to so many people in different industries that there's so much money that at the top, they just don't care. They're going to do what they want to do and invest in what they want to invest in and focus on what they want to focus on because they want to. And we're talking about trillions of dollars here. In other industries like Hollywood, you see a lot of this happening. You've got millions and billions and people they don't care if they lose money. They're going to accomplish their goals one way or another. Is the same thing happening with BlackRock and Vanguard and State Street, and they're just not sharing that mindset with the investors?
Yeah, so let me make a couple of points on that. First of all, if you want to talk about ESG and DEI and exec comp, well, in 2022, this was one of BlackRock's top priorities. And we haven't talked about the proxy advisory services yet, but this is a good time to bring them up. So there's 2 proxy advisory firms that control about 97% of the market, most reporting shows. And they're called Institutional Shareholder Services and Glass Lewis. Again, control about 97% of the market. ISS also pushes ESG in exec comp. They even have a portion of their website that gives examples on how to do it. And so there's a lot of pressure for companies to do this. right? But again, you just mentioned like there's leadership. They just want to push this DEI. They don't care if they lose money. Well, that's a fiduciary breach in and of itself, is it not? That's like an admission that you're violating your fiduciary duty to your shareholders. But I will tell you some positive news, Kyle, in this space. I know a lot of times I can just like be the bearer of tons of bad news, but there is some positive news in this space. And that is this. There are in our voting, we have identified this season more than 60 companies that last year tied exec comp to ESG, DEI type metrics that this year took it out. That was our number one engagement topic last season. We engaged with more businesses about their bad, in our opinion, executive compensation practices than any other topic. So again, we may be small in size in comparison to the behemoths of BlackRock, State Street, and Vanguard. So while they have bazookas, we have a scalpel, and we're wielding it mightily to affect change in corporate America. That is a major victory to have this many companies walking away from a practice that they did just the year before.
Hmm.
And so, yeah, we're having outsized influence. We're definitely punching above our weight class when it comes to how we're using our voting and engagement to change corporate America for the better.
No, that's amazing and so impressive too. You guys are really accomplishing so much and being tremendously effective there at Strive. Justin, talk to me a little bit about and for our politically basic listeners to understand the connection between corporate America or our free market system, really, and politics, our government, our leadership. A lot of what happens coming from the top, coming out of an administration, affects our markets, obviously affects our economy and Americans' financial situations, which we're hearing certainly a lot of complaints about these days. How would you describe that relationship?
Yeah, I would describe it as hand in glove these days, right? And so, your listeners probably remember what President Biden did on his first day in office. And when I ask most folks, they remember, well, he canceled the Keystone XL pipeline with the stroke of a pen. Well, what was the second thing he did on the first day in office? Most folks don't know this. What he did was he canceled President Trump era Department of Labor regulation rules. And these rules said that fund managers had to invest solely for pecuniary, that is, pro fiduciary financial reasons. So they could not invest in social causes, ESG type causes, that was forbidden. We can get a little more technical on that if you want, but broadly speaking, that's what they said, is you have to invest for pro fiduciary reasons. The second thing he did was to cancel those, and his Department of Labor replaced them with rules saying, no, go ahead and invest for ESG reasons. Absolutely. That's how political this topic has gotten. That President Biden's second thing he did was to make sure ESG could get back in place for those fund managers. And interestingly enough, when those rules came out, Congress got together and did something very bizarre for Congress. They passed bipartisan legislation saying, no, these new rules are wrong. This is politicizing the capital markets. And they passed legislation overturning President Biden's Department of Labor.
Yeah, I don't think a lot of people know that at all. That's really, it's good that they did that. Surprising that President Biden did that. It seemed like he came into office day one with a long list of to-dos, and he got right to it. And I think that the American people, obviously at that time, right, we had just had COVID, January 6th happened, Joe Biden is installed as president and everyone's heads are swirling. And then he starts ticking off this long list of like, I'm going to change things, to do with the border security and immigration. And now this too, it's just like so many things I think got slipped in there that people had no idea about. I didn't hear that at all. That's really surprising.
Yeah, well, and the other, add on to that that shows how important this is to the Biden administration, that was his very first veto, was to cancel that bipartisan congressional legislation pushing back on his Department of Labor. That was his very first presidential veto. And so that's how important this is. We've also got, outside of the Department of Labor, we've got the Securities and Exchange Commission under Gary Gensler that is just trying to ram ESG down corporate America's throat through, climate disclosure increases that have nothing to do with the mandate of the Securities and Exchange Commission. So thankfully, that's being tied up in the court system right now. But believe me, the federal government has lots of tools, and they're using them to try and advance this, again, stakeholder model of, I mean, I call it stakeholder theory. Some people call it stakeholder capitalism, but I don't like putting those two words next to each other. And so, yeah, they're using a lot of the tools at their disposal to try and ram this down the throats of everyday Americans. And I think that, you know, Bidenomics through the inflation has really harmed folks in the pocketbook, but so too has the ESG movement. And again, since they're working in tandem, it's almost like there's a multiplier effect that are really driving up prices for everyday Americans. And I think that if we get back to shareholder primacy, we get away from this stakeholder model, not only will the companies thrive and the shareholders thrive, but so too will the American people.
Yeah. All right, I want to ask you a question. I hope you can answer for me. I know you know the answer. I just want to see if you're going to say it. We're watching a whole lot of politicians assume office with not a lot of money in the bank. They're making 130, 150, maybe high 100 and something thousand a year. And they're worth like $30 million, Justin. Nancy Pelosi has been one that people have really identified as a head scratcher on how she is worth hundreds of millions of dollars, having spent most of her life in political leadership. Doesn't always pay the bills, but something's paying the bills. And most people think that it has to do with some insider information that they're gleaning while in those positions. What's your take?
No, she's just really lucky. Yeah, of course. Now, of course, there's plenty of insider information that members of Congress get all the time, and that they trade on it. And so, there's folks who literally just follow Nancy Pelosi's trading patterns now. So
Isn't that? I mean, isn't it illegal? Isn't it insider trading? Is it
well,
not? Is she getting around the edges somehow?
they all are. She's obviously like the tip of the spear, but yeah, this is something that Congress itself should look inward and realize, you've got an approval rating lower than the mainstream media for a reason. And this is one of those reasons. And so they should self-correct this. And if not, the electorate should demand it. And if not, the court should fix it.
Yeah. Well, happy for them. They're doing great. Overall, the economic and financial health of our nation, we've talked about people struggling at home and things seeming just challenging right now economically. What would you say when you take a step back and look at just the overall financial health? We're in $35 trillion worth of debt, and that doesn't seem like that's going down anytime soon. What do you think? Where do you think we're headed?
It's a bad place. And I would say look to the states, though. Right. At the federal level, it is absolutely a disaster. The spending, a lot of the COVID money that was spent was on things that had absolutely nothing to do with COVID. Right. But once the money was appropriated, of course, they were always going to spend it. They're not going to put it back in the till. So I think, the founders set up, not just a tripart government, federal government with accountability, but a federalist system. Right. And so you can look to the states where people are voting with their feet, like Texas, like Florida. Interestingly enough, companies are deciding to no longer domicile in Delaware because Delaware has become not quite so shareholder friendly. And so Tesla, for example, just had a recent shareholder vote where they approved moving the headquarters of Tesla from Delaware to Texas. A lot of companies are deciding to domicile in Nevada. And so I think that, yes, the federal, budget and deficit is a scary number. I think Congressman Thomas Massey, like, wears a button where he's got the deficit, like, you know, virtually going constantly, it's to shock his colleagues, and I hope more of them get shocked by it. But, we the founders set up, state laboratories, and some states are showing how to get it done correctly. Again, like Florida, like Texas, and other states like California and New York are showing what a death spiral looks like.
Hmm. Yeah, well, domiciling or re-domiciling in a more friendly state. We sure saw a lot of that after 2020 and during 2020. And I think for anybody who had any stock in U-Haul, they were certainly on the up after that. That was like their numbers were through the roof, which was entertaining to follow. So, Justin, we've talked a little bit about what you can do as a shareholder to use your voice to make sure you're voting and participate in this process of where your dollars are going and what they're doing. But for those who have not invested yet or have not taken that step to participate in this process, maybe they think they don't have enough money to initially get into the markets. What advice would you give those who are either unsure or are considering investing but haven't done so yet?
Yeah, I think that a lot of Americans see it as scary, right? And, to answer a little bit more of your last question, then I'll tie it into this one too. I think when it comes to big picture on the economy, there's always a disconnect between Wall Street and Main Street, right? So you can't really look at the health of a full economy by just saying, oh, look, the Dow was up again last week. That has nothing to do with 50% of Americans that aren't invested in the capital markets at all. Right. So judging the health of an economy by looking at the tickers is a terrible way of judging the full picture of the health of the economy. But then I would say that there's a lot of platforms, and I'm not going to endorse one or the other, that have really democratized the way that folks can get invested in the market. And so you don't need to have a broker that you pay a whole lot of money to. You can set up your own online accounts, connect them with your bank, and buy shares of companies. And so that's what I would recommend folks that are interested. Dip your toe in the water. Don't put your life savings in one single company. Diversify what you're looking at. And again, without endorsing anybody's products, you can easily invest a small amount, diversify it, and get exposure to broad sectors, to broad markets. And it's very simple these days. It's not something to be scared of.
Yeah, absolutely. And it sounds like you guys at Strive have so many great resources for people. Either they're just jumping in or thinking about it, or they're already well invested, that they can go on your website and take a look at all of those papers, research, guidance that you guys have on your site. So that sounds amazing. Well, Justin, thank you so much for giving us time here today on Politically Basic. I've learned a lot. I know my listeners are really getting a lot out of what you're breaking down and sharing. So thank you so much for your time today and for being with us.
Absolutely. It was my pleasure. Thanks, Kyle.
And thank you for joining us for this episode of Politically Basic, where we break down the basics of all political issues and let you decide. Be sure you're following us at politicallybasic.com and at Politically Basic on all socials so you don't miss a single episode. See you next time.